So many of you like when I do those analysis videos on stocks that Michael Burry bought, on stocks like Warren Buffett bought, and many other super investors. And there's something in common between Michael Burry and Warren Buffett is that they both actually own Charter's communication stock. Michael Burry has recently bought it, and Buffett already owns the stock, and it makes up around 7% of Michael Burry's US portfolio, not his international portfolio. But not only Warren Buffett and Michael Burry are buying the stock, but the insiders have also been buying the stock. There's this director, he bought over 27,000 shares, amounting over $10 million at $374 per share. Insiders, they have been selling before around the 670 range, in the 450 range, but no one has sold under $400 per share. And the insider actually put over $10 million of his own money, around $374 per share. And the stock right now is sitting at $380, which is really not far at all from whenever the insider actually bought it. Now, insiders buying don't really mean too much, but it normally means that the insiders who know much more than we do actually believe the stock is undervalued. But they can also make mistakes just like we can make mistakes. As I remember a stock like DocuSign, many people were buying just because the insider was buying, and it's the same thing with SoFi stock. And yet, even those insiders were buying, the stock kept going down, it kept making a new 52-week low, as a lot of bad things happened in the future with those companies, which is why, again, you can't 100% rely on just insiders buying or just Michael Burry buying. But again, looking at a chart of the PE ratio of Charter Communications stock, which I'm sure most of you are actually familiar with the business. They own Spectrum, which has Spectrum Mobile, Spectrum Wireless, Spectrum TV on the cable news channels, and many other things. And it's kind of like a Comcast, but mostly around, especially internet and many other services that they actually have. But this company was sitting at a PE ratio of over 22. It's actually a little bit higher than that. It was sitting over 40 times earnings, 43 times earnings. And now we went up from 43 times earnings from early 2020. Now it's only trading at 11 times earnings. And it's trading around a 9% free cash flow yield for this investment. Now, looking at their latest earnings type of presentation, they actually grew revenue over 3.1%. But there's a catch to that. It's mostly came from their advertising revenue, which grew over 22%. Now, the main reason it grew 22% was because we had election years in the midterm elections in the United States, which, of course, is going to show a 22% type of growth. But needless to say, they did grow very low single digits, pretty much, even lower than single digits on residential and customers, which amounted to 3.1% revenue growth. Now, the company is facing a challenge in growing revenue, and it's actually losing a lot of subscribers from 2021. It's losing on the video, it's losing on voice, year-over-year change. It's gaining on mobile lines. And there could be many reasons around this. Many of it could actually be with people moving to a different state or moving around or seasonality. But what I believe it really has to do with is we had a lot of pretty much peak demand in 2021 in this whole industry with, videos and voice and internet. Many people are just, moving to other type of services. As I see a lot of people on Twitter and in many other places, they actually have bad comments and a bad feedback to give around Spectrum. Many people say that Spectrum Wireless is not reliable, or they switch to another service and they prefer that service over Spectrum Wireless for their internet, and many of them canceled their TV subscription on video, and they actually signed up to things like Paramount Plus, like Netflix, like HBO Max, and a couple of other things. So this has all to do with it. But again, the company is losing subscriber, is trying to make up for the revenue growth by hiking prices, which has been working, a little bit good, and they're gonna keep doing it. This is what the management said. So it's a pretty much a flat revenue type of company to low single digits. It's not a exciting story, and it's not a very high revenue type of thing. And they can hike prices much more, as the residential revenue is pretty much the same per customer since 2021. I believe there's some price improvements to be done, but they cannot do it too much, as they have a lot of competition. Now, one thing that I don't really like with the company, and we're going to talk about it a little bit more, is their long-term debt. Every single year, the debt is skyrocketing. It was over around 13 billion, pretty close to 13 billion in 2012, and now it's approaching $90 billion. It's around $88.5 billion. Now, that's a lot of debt for such a company, and the management is not really paying it off. Instead, they are focusing on buybacks. And I do understand why they are not really paying it off, because 85% of the debt is fixed. They have around a 4.9% of a cost of debt. No big maturities are happening until 2025 and 2027, around $12 billion, which the company, I don't believe they can meet. Maybe they can pay it off a little bit every single year as they are a free cash flow type of machine, but they will most likely refinance the debt as they have pretty high and sustained free cash flow. And from now till, 2027 or 2029, maybe the interest rates would be low again, and then they can refinance those things at much lower interest rates and then push it up to the future. So it might be a good strategy for them to focus on buybacks if they believe the stock is undervalued. But I really disagree with them. Yes, the stock is undervalued right now, but the stock was trading over 40 times earnings. The stock used to trade, if you actually scroll up a little bit, the stock used to trade around $600 per share. It touched over $800 per share. And the company was buying back at $800 per share. So that does not show a lot of value to shareholders, in my opinion. They should have been paying back debt whenever they had such sky-high valuation, and they should be buying back stock as they are doing right now, as the stock is pretty close to its 52-week low. So I believe this is a mistake from the management, but it doesn't really change the investment case with Charter stock. All right. Now, as they were focusing on the buybacks, as we talked about, since 2016, the company has bought back around 46% of their shares outstanding. This is massive, massive. Around 2% of their shares, they bought them in Q3 alone. So they are buying 8 to 10% of the company back every single year, as they are focusing more on buybacks than actually paying down the debt. And they can do it as they have pretty sustained and pretty resilient free cash flow for the company. They did suffer some lower free cash flow because they're putting some CapEx around a couple of other projects for the company, which is going to pay off a lot in the future. But I believe their free cash flow is sustainable, and they can actually afford to do the buybacks and pay back some debt. As we can look at the shares outstanding, I mean, they have been gone massively from 2017. Even they are now around 173 million shares, I believe, for late 2022, which is, again, this is the strategy that the company is using, and it's been working amazingly well. But I believe not all of it is such value for shareholders. I think now they're doing the right thing by buying back stock, but I was not happy when they were buying back stock at $800 per share. All right. Now, this is my valuation model on the company, which I believe is very conservative. I'm going to talk about it and to look and see if the stock is actually a buy at those prices, or if it's maybe a little bit expensive and we should wait for a better price. Now, as the company now is flat to revenue growth 2 to 3%, I expected 2% revenue growth only from 2023 to 2027, so around 5 years from now, which I believe is fair. There's a decent chance they can even decline in revenue, but they used to grow 4 to 5% a year. I think they're going to go from 5% to a sustained 2% on average for the next 5 years, and I believe this is fair. Their net income margin right now is 10%, so I use the same one of 10%. This is around $6 billion of net income in 5 years from now, which is 2027. Now, for a PE multiple, I used a 15 PE ratio, and the PE now is 11, which I'm pricing in a multiple expansion for the company. Now, why am I actually doing that? I believe the company is trading at such low multiples, and I used to trade much, much higher historically, mainly from the uncertainty around people canceling their subscription from 2022, and we had peak subscriptions and peak, a lot of services in 2021, which I don't believe is a fair comparison, and I believe the market is really too bearish on Charter. And 11 PE for such a sustained free cash flow type of business, I believe is very, very cheap for a company like Charter Communications. So I'm pricing in a 15 PE for 2027, as I believe they're going to continue to buy back stock. They're going to continue, hopefully start to take the debt repayments more seriously, which the management has been actually talking about. So again, 5 years from now, I don't believe there will be this uncertainty that it is right now. I'm not saying Charter is going to go back to a 27 PE, but I believe a 15 PE is fair for the company. Now, using a 15 PE on the company, I get a $90 billion market cap. The market cap right now is $60 billion. So this is around a 51% on the upside over the next 5 years, or only 9% compounded every single year for the next 5 years. Now, this estimate does not include the shareholder value that you're going to get from the buyback, which they do buy back around 8 to 10% of the market cap every single year. So that could be around another 45 to 50% return, which could equal around a 90 to 100% return on the stock over the next 5 years. Now, looking at a 100% return with the buybacks over the next 5 years, it could make Charter Communication stock actually a buy. But for me personally, for my own selective type of portfolio, I'm not really going to buy Charter stock at those prices. Although I believe the company could get back to 20 PE and it could be much better. But I believe there are better options with the market. And if Charter was providing a 70 to 80% type of upside with my valuation model, not including buybacks, maybe with buybacks it would be close to 150%. Now, to me, this is much more interesting and it would be worth the risk reward with Charter. But I believe if you're looking for a pretty decent return, 10 to 12%, 13% every single year, conservatively, again, assuming the PE ratio stays at 15 and they only grow 2%, I believe Charter is a buy. But for me personally, I am not buying Charter. I'm willing to wait on it and be a little bit more patient, maybe around $300 per share. I think the company would offer much better risk reward for me. All right. So this is my analysis on this Michael Burry stock. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.